Okay, so now we have the final highlight, contrasting different monetary models with Sebastian. The floor is yours.
All right, Marcus, thanks for introducing me. I don't know whether it's a highlight, let's see. So Marcus asked me to give this lecture, which is not really about one paper, but which is more a type of summary of what I've learned trying to understand what other people think about money. Though partially what I'm telling you today is related to a paper that I have with Sang, who is also here, and that I come in the very end. So first of all, so I will in the end talk about a safe asset model again, but before I get there, I will turn over a lot of things and look at very uninteresting models because they're super simple, but they can be the basis to add money to it, and then we will talk about how adding money in different ways has an effect or has no effect on real stuff and on nominal stuff. And Marcus promised I will also have a monetarist model. Actually, I don't, because I have already too much stuff, and I just cut that away. This one doesn't work, I think. Let's do it like this then. Maybe now? No, now it works. Okay, so let's start with some questions. So this is some questions that I came up with ex post, not ex ante before I did it. So I hope I can answer most of them. So one question is, what determines the price level or what determines inflation? That's certainly currently an important topic because we have high inflation rates, and it would be nice to know how to bring them down. What does interest rate, or how does interest rate policy affect the economy? So that is an important question. When and how are fiscal policy and government debt relevant for inflation? So Marcus has talked a lot about government debt. He has talked about how if you have more of these bonds, that generates inflation and stuff like that. But there are theories that say government debt doesn't matter. So that's another question. Then what is the role? That's a bit more technical, you may say, but actually is important. What's the role of equilibrium multiplicity? Because in many monetary models we have equilibrium multiplicity and coordination of different expectations. And then finally, that's something that's particularly interesting to us, that we work with these models where there's portfolio choice. Does portfolio choice actually play a role for money, for inflation, for aggregate demand? Or at least when does it do so? Okay? And particularly I think here about the portfolio choice between nominal government liabilities and other assets. For example, as in the other model before, there was a safe asset, that was a nominal government liability, and there was capital. Okay? So I want to think about these questions broadly through the lenses of some models. So I will not tell you anything about the world, but I will just look through some models and ask what do these models tell us. Okay, here's the outline. I will briefly go through a baseline real model. It's a super simple model. Then I'm going to add money first as a pure unit of account, and then we will have that in flexible prices, we have that in sticky prices, and I look at interest rate policy. And that will cover most of the kind of conventional new Keynesian stuff, so representative agents. I will not go in newer Hank stuff. Then I will add government debt. I will talk about the fiscal theory of the price level. And there you will already see portfolio choice is going to play a role because there are going to be these nominal bonds. And then I talk about equilibrium dynamics if fiscal policy is what sometimes is called active. And I talk about how we can eliminate that stuff and go back right here where fiscal policy doesn't matter. And then fiscal policy has to do something about it. And finally, I talk about what if there's a safe asset demand for government debt. How does that change the picture? Okay, let's briefly go to the real model. This is super simple. There's house, so it's I say a K economy, you could also call it endowment economy, because basically I turn off any growth effect. So they're households, they have log utility, you've seen that before today. Each of these guys manages some capital, KIT. Capital just produces AT times KIT. AT is going to be, so I'm not actually having aggregate shocks here. So my analysis is always going to be, there is some exogenous path for productivity, for possibly idiosyncratic risk later on that's given to you, and possibly at time zero there's something like a zero probability or MIT shock, but there is not actually anticipated aggregate risk. You could extend this, but this just makes it simpler. There's no investment, no depreciation, meaning the aggregate capital stock is constant, and I will just put it to 1. So I'll just put it to 1. And there's capital is traded on capital markets as before as real price per unit of capital. Okay, so I'm putting the capital stock to 1, meaning QK is also the real value of all capital in the economy. And then what's goods market clearing? well, aggregate consumption is just the integral over all these guys. That must be aggregate output. That's what all these guys produce, and that's just AT times capital K. Okay? And because they are all the same, there's no idiosyncratic risk. We can actually assume that there's a representative agent. So if they all have the same capital in the beginning, then they consume all the same. Otherwise, they consume just proportional to their initial capital holdings. So this model is trivial to solve. So market clearing, I'll just solve for the aggregates because everyone is the same up to scale possibly. Market clearing just tells us consumption, there's no investment, is equal to output. Output is A times K, but K is 1, so it's just A. Log utility tells us also each individual guy wants to consume rho times net worth. We have already determined consumption, so basically this equation is going to give us what the capital price is. Okay, so the capital price is just A divided by rho. And then we can also recover the interest rate from the Household-Euler equation. So I write this in terms of aggregate consumption because, again, it's proportional to individual consumption. So the interest rate is the Euler equation is this equation. And here I have a notational convention for today. The Euler equation is conceptually a backward equation. It's forward-looking. So there is a terminal condition, it's a transversality condition, and then you're going backward in time, and then you figure out what your consumption today is. Even though I don't have risk in the end, I will kind of make clear in my notation that we are talking here about what you expect about the future. So all backward equations, I will have this expectation operator in front of it. And for forward equation, for state evolutions, I will not have it. Okay, just that we always see this is a backward equation. The initial value can jump because I'm working back from a terminal condition. Whereas if you don't have that, then the initial value is fixed and we are moving forward in time, like a capital evolution, for example. So the Euler equation is this. Your expected change in consumption is equal to, well, actually your expected consumption growth, if you bring this to the other side, is equal to the interest rate minus rho. Okay, and there's no risk because there are no risk terms because there's no risk. There's no growth term because there's no growth. So remember, Marcus had this Ramsey term with growth, and well, actually it's in here in your consumption growth, but it's going to be actually there's growth. Sorry, forget about this. The Ramsey term is there, but he had a risk term about the precautionary motive that is not there because there's no risk. Okay, we can solve this for R, then we get the equation that Marcus had without the precautionary term. And let's call it just rho plus mu AT, so that's the growth rate in productivity. Let's call that R star. That's just going to be the real interest rate, and later that's going to be our natural rate. Okay, this model is boring, and it's also not useful to add money, at least not if you want to go New Keynesian and want to also add price stickiness. And the reason is that each period, basically output is fixed. Short-term output is fixed. Okay, there's nothing you can do about it. You have to produce A. And if you don't have demand for A, markets won't clear. So we need two features to even think about adding price stickiness to the model. And let me just spell them out. You all know that from grad school, but let me just spell out what all sticky price models need if you want markets to clear. First, they need elastic short-term supply, meaning within a DT period. Why? Because if some price is rigid, then it's wrong relative to the flexible price model. And therefore, you have demand that's excessive or insufficient relative to the flexible price model. And so supply has to adjust. Otherwise, the market doesn't clear, and then we would have to add some rationing also. Usually, we don't like that. So supply needs some short-run elasticity. I'm going to add capital utilization. Often we have labor. In this model, we add capital utilization. The second thing that you need is you need price-setting firms that face a not perfectly elastic demand. So in a valuation market like the one in the model before, everyone is a price taker. Everyone faces a flat demand curve. And therefore, you think, well, if I put my price a bit higher than the market price, I face no demand. If I put it a bit lower, I face infinite demand. That's not a good starting point for adding a price setting problem to it. So what we need is a downward sloping demand curve. So what I'm doing is very standard. I'm going to add differentiated goods in monopolistic competition. Most of the New Keynesian literature does that. That adds distortions. I don't like distortions, so I get rid of them with some transfers and subsidies. So in the end, what I'm getting, very shortly, let me show you the model. In the end, what I'm getting is a model that generates exactly the same outcome as my baseline model, but it has these additional features that later allows me to introduce sticky prices. So households have, again, preferences for consumption, but now they have to put in effort to utilize their capital. Okay? Have to put in effort to utilize their capital, and that generates some disutility. Then there's a CES demand for goods, so there are different varieties J, and this just has a CES aggregate. This is aggregate output that you then consume in your utility function. That generates a standard demand for variety, and then our households don't produce themselves. Now they rent out the capital to some firms that produce these variety goods. And how much you rent out? Well, it's the effective units that you rent out is the capital you have times how much you utilize it. Okay, and if you work harder to utilize it, it's just more costly in utility terms. You rent it out at some price to these firms. These firms just produce A times effective units of capital. So there is this U of these households implicitly inside there. And then they have some standard profits. Okay, there is some subsidy to eliminate the monopoly distortion. So that's very standard. The solution is very standard and boring. These firms have flexible prices. They set now their price. And if we put in the right subsidy, they set the price exactly to the marginal cost. So exactly to the the price exactly to the marginal productivity. And therefore, they are in the end, there's not really any distortion here. It's the same as in the original model. So households still get A times K, or A times UK actually, for each unit of effective capital that they give to firms. That's exactly as before. And then if you look at the household utilization, well, what's the gain of utilizing a bit more? You get this rental rate. How much units of capital do you produce by utilizing more? Depends on how many capital units you have, because it's linear with your capital. But what's the utility cost? Well, your marginal utility, or what's the value of that in consumption units times the marginal utility of consumption. That's the benefit, but the cost is you also have a utility cost. And then you equalize those two, and then you get that you equalize the rental price to this term here, and then in equilibrium with the rental price is equal to the average, the marginal productivity, you just utilize one, and we're back at the old model. Okay, and so we get the identical conclusions to the baseline model. But now what have we achieved? Now we have firms with a downward sloping demand curve, and we have households that can adjust supply if there is more demand. Okay, so now we have these two kind of flexibility features that we need for markets to clear with wrong prices. By the way, just a remark, I gave you strange framing of this model because this is really the standard model from Gali. Just utilization is called labor, rental price is called wage, and we don't have capital, or I would call it productivity. Then it's a standard New Keynesian model, the real side of it. Why do I use this unconventional capital formulation? Well, for one, it's closer to the type of models you see this weekend. And the other reason, that's a more substantive reason, in the safe asset modulator, it's going to matter. Because capital you can trade, but labor it's a bit hard to trade. And if you have this labor risk, then it's hard to aggregate. With capital, it's very easy. Okay? Any questions so far? OK, so let's add money. So far, this was all real. This was just preparation. Let's add money, and let's start with flexible goods prices. So I want to introduce dollars. Dollars are a pure unit of account. There are no actual dollars in the economy. And let's call P calligraphic the price level. So all calligraphic variables will be nominal variables, and all normal letters will be real. The exception is the normal rate, which is I, because there are, I think, no lowercase calligraphics. OK. P is the dollar price of an aggregate consumption good, so the CES aggregate. And we limit attention to the deterministic price path, so where you have some inflation rate, but you don't have jumps in the price. Okay, that's just for simplicity. And there are two ways how we connect the dollars to our real economy that I've just introduced before. One is, let's impose that firms have to quote their prices in dollars. So instead of having this little piece, this real prices, they quote their prices in units of dollars. That by itself doesn't do anything to the model, because suppose you want to set any real price, you're facing the price level capital P, you can always implement your real price little p by setting the nominal price as this. Okay, so merely imposing that people set their prices in dollars doesn't do anything to the economy, so it doesn't impose any restrictions on the aggregate price level. The other thing does do something. So suppose we add nominal bonds in zero net supply. So the bond return is, well, you get a nominal interest rate, but then you have a change in the value of those bonds, because 1 over PT is the value of one bond. So it's I minus pi. That's your real return. Okay, so and we assume that the interest rate is set by some external authority. So we are all agreeing that we're trading these normal bonds, they're zero net supply, but we are all obeying this interest rate. So this is not going to change to clear the market, but this is set externally, and then the only thing that's actually left to clear the market is going to be the inflation. Okay? And how that works we talk about. But that basically will generate some restrictions on what inflation and what the price level can be. Okay? In a very broad sense, you could say, in a sense, it's not just a unit of account. I have introduced something like a store of value, because each individual guy, each of you thinks, I can save in nominal bonds. Of course, in the aggregate, it has to add up to zero. But each individual thinks I can save. So it looks a bit like in a very broad sense, like a store of value. Okay, let's solve that monetary model. Same model as before. We have just prices. Goods are quoted in dollars, and we have these nominal bonds. And let me do it very inefficiently, but later with sticky prices, that's actually closer to how you would do it. So let's derive what is sometimes called the IS equation. We have an Euler equation. That's as before. Okay, this is how your consumption, you expect your consumption to evolve in the future, and it depends on the interest rate versus your discount rate. Then there's goods market clearing. So let's plug that in here. And let's use that A is a state variable. So A is something that we know. Okay, there's no future shocks. And U is not a state variable. U is something that can jump. So U is only determined. So basically, this Euler equation is going to be a backward equation or a forward-looking equation for utilization. Okay, we can plug that in here. Then let's also use the portfolio choice between real and nominal bonds. That gives us a Fisher equation. The real rate is equal to the interest rate, the nominal rate, minus inflation. Let's plug that in there. Then we get this equation here, where I've used, again, this definition of the natural rate, that the change in utilization, which is also the change in output, okay, or the growth rate in utilization that people expect, is equal to the difference between the actual real rate in this economy minus the natural rate, and the actual real rate is I minus pi. Okay? So that's sometimes called an IS equation in New Keynesian economics. Then we have three equations, not the standard three equations that people talk about, that really pin down these three variables: the price level, the utilization, which is kind of how much does output move, and the inflation rate. Okay, this first one is the price evolution. Okay, and it has an expectation term here because prices can jump. We have inflexible prices, so this is not a state variable yet. Prices can jump. Then we have this IS equation, and then we have seen from the price setting and optimal utilization, which is the same as in the real model, utilization is going to be 1. Okay, so this is just because firms adjust prices until that happens, because the prices are flexible. So the third equation is going to tell us utilization is never going to change. Let's plug that in here. That is going to tell us the real rate is equal to the natural rate, and that is going to tell us what the inflation rate is. Inflation is the normal rate minus the natural rate, but nothing tells us what the initial price level is. Okay, and there's no other equilibrium condition that does. So there is a mild form of multiplicity here that what is the value of dollars, it's not determined. Okay? We can also recover the rest of the equations, but that's not what I'm concerned with. Okay, the real side is the same as in the real model. The nominal side has these two features. Inflation is now determined by this Fisher equation, by this equation here, but the initial price level is undetermined. And therefore, for any given interest rate path, so I'm not talking about we look across interest rates path. For any given interest rate path, you have a continuum of equilibria. They all have the same inflation rates, but they have a different initial price level. Okay? So that is the kind of the first type of money as a unit of account type of model where you only have a Fisher equation. So what is? Let me have a small detour and ask what is actually the mechanism behind this Fisher equation, because it's not so clear. Why does actually inflation kind of? I mean, it's clear from the math. It's clear that you need inflation to adjust to make this portfolio, to make the Fisher equation hold. But how does it actually work? So how are firms induced to change their prices? Okay, because ultimately inflation comes from firms changing prices. So there are two interpretations, or any mixture of the two. Suppose the normal interest rate rises. Interpretation one, so it may be that the current price drops. Okay, suppose our expectations of the future price is given. Interest rate goes up. Okay, that for fixed expectation of the future price, if the current price doesn't move, then the real rate is too low because inflation is too low. The interest rate is high. The real rate is too high because inflation hasn't moved. The interest rate goes up. The real rate goes up. That depresses demand today. Firms lower their prices, and that lowers the price today. So that's one way. We expect a future fixed price. Price goes lower today. Okay. There is another way how I could think about it. Suppose it could also be that the future prices rise. The current price stays fixed, but we need a higher inflation rate to make the Fisher equation hold. Future prices may just rise faster. Okay? And somehow maybe the behavior in future periods will validate those beliefs. How exactly, the model doesn't tell us. So this model isn't really giving us the answer what happens here. It suggests a bit this first interpretation because we have derived this whole thing from a backward equation. And the backward equation, the way to look at this is something later in the future is fixed, and then we're moving backward in time. So we're forming expectations about the future, and then we're moving backward. That is suggestive of this interpretation. But ultimately, there's nothing in the model, within this model, that doesn't tell us if interest rates rise, people expect higher prices in the future. So in a sense, this model is not so nice because it has this multiplicity, and it doesn't even tell us how inflation rises when the interest rate rises. Okay? So one way to get around this is say, let's just fix this price today. Let's just add sticky prices. Okay. So let's add sticky prices. For example, with quadratic adjustment costs, you could do other things, and that replaces the utilization is always 1. Okay? It replaces that with a new Keynesian-Phillips curve. I don't have the derivation here, but I'm sure you have seen this at least in discrete time. This is the continuous time version. The expected change in inflation is equal to rho times current inflation minus some Phillips curve slope times the difference in the unit marginal cost for the firms minus 1, and the 1 comes here because I have made everything efficient in the flexible price limit. And you can write this using the equations we derived before in terms of your utilization. And then utilization is a bit like an output gap measure. If it's smaller than 1, then you have a negative output gap, and if it's larger than 1, you have a positive output gap. Okay? So what does this equation tell us? This equation tells us that the Phillips curve is ultimately about you want to smooth inflation because you have this rho pi term here. So you're discounting future inflation if you're discounting this up. So you want to smooth kind of this future marginal costs gap over time because it's costly to move inflation. So this doesn't actually change much the economic logic from the flexible price model. It just says we want to smooth everything out. It's a bit like the Tobin's Q equation with the capital adjustment cost, except that it's more dynamic. That you have some adjustment costs, so you don't want to change your the thing that is hard to adjust immediately. In the Tobin's Q, it's the investment rate. Here, it's the price, and instead you want to adjust some other margin. Okay, and here it's how much you produce. The problem with this equation is, even though it's not so hard, it adds a second forward-looking equation to the system that makes it all a bit less transparent. So what I'm going to do to make everything simpler is I'm just dropping the expectation term, okay? And I relabel the coefficient, and I add a static Phillips curve that doesn't have an expectation term. So why am I doing this? Because for most what I'm telling you now, it won't really matter. For some things it does matter, but these are small details. Okay, so this makes it just easier. That's why I'm doing it. And you get a bit the same flavor of it. You can also microfound this thing, but it's kind of crude to get the static Phillips curve. So it's not very natural microfoundations that generate that. Okay, so here's our sticky price version of the 3 equilibrium condition I had before. There's the price level evolution, and now I drop the expectation. And actually, the initial price level is fixed. Okay? Now the price is a state variable. So that's the first change. The price is now a state variable. You have the IS equation hasn't changed at all. And now you have replaced u equals to 1 with that Phillips curve that relates the inflation to some measure of the output gap. Okay. And then you have all these other equations that are just as before, but I will just focus on these 3. So here are the differences. P is now a state variable, and the IS curve plus the Phillips curve now leave room for multiple pairs of inflation and utilization to solve these 2 equations. So why is that? Because we have this forward-looking equation, but we don't have a terminal condition. Okay? So that's the same, actually, I didn't tell you that. It was the same here. We don't have a terminal condition for u. Yes, we do have a transversality condition, but I plugged already everything in, and actually I used already the transversality condition implicitly. And there is no transversality condition for u itself. Okay, sorry for jumping in the wrong direction. So there is no terminal condition here, and therefore expectations can move to just multiple terminal conditions. So we're getting the same conclusion as before at the end of the day. Suppose we have an interest rate path. I'm also going to make it bounded here, but forget about that for a moment. We can substitute the Phillips curve, because it's static, into the IS equation. We get a one-dimensional evolution. So I is given, the natural rate path is given. So this is really a one-dimensional differential equation, a backward differential equation without a terminal condition. So there are multiple solutions. Okay? There's a continuum of solutions. You can think about this. Fix a condition of utilization or inflation at some point in the future. Then we can solve backward. Then we have a unique solution. But which condition you pick, that is just arbitrary. And we can index these equilibria at any time, capital T, by utilizations from 0 to infinity, or by inflation rates from minus infinity to infinity. Okay, forget about this. So we get, again, a one-dimensional continuum of equilibria, as in the flexo price model. The difference is only in the flexo price model, it was the initial price level, and now it's the path of inflation rates, or the inflation rate in any period. That's enough to index it. But that's actually a fairly small difference, and in some sense you can actually combine. When you lower price stickiness, you can actually find a path of equilibria that move you directly to the one-to-one correspondence between sticky price equilibria and flexible price equilibria with price level jumps, at least in this model. Okay, any questions so far? This is just a model. Let's do interest rate policy. We call this equation, we've combined the IS and the Phillips equation. That gives you a forward-looking equation for utilization. And now let's suppose we fix an anchor, or we anchor some expectation of utilization, or equivalent to the Phillips curve, of inflation in the future. In some future period, say in 3 years from now, we all believe inflation is 2%. Okay? I don't think we do believe that, but suppose we did. Okay? And now we raise the interest rates. What's going to happen? Okay? Conditional on we all believing in 3 years the interest rate is 2%. The higher interest rates are going to raise the expected growth rate of u. Where do we see this? We see this here. Okay? Because here's a u, so they raise the expected growth rate of u. But we are holding fixed the future u. So if we're raising the growth rate, then the current u has to fall, that we are ending up here. Okay? So that's what's going to happen. The current u is going to fall, and with it inflation. So for fixed future expectations, we get that inflation and output today fall. So that's, I think, the standard intuition. But that's for fixed future expectations. We could also use a different equilibrium selection, where when you raise the interest rate, expectations of future inflation go up, okay? Or of future output gaps go up, which is the same in this little model. And then you could have that actually now there is no deflationary pressure, but potentially even that now inflation goes up when you raise the interest rates. So if you move this anchor around with policy, you can, for example, get so-called neo-Fisherian conclusion that higher interest rates lead to higher inflation. Here's a little picture that shows you that. So here's my world. So there's 2% interest rate and 0% inflation in the long run. So this is just my natural rate. And that's also how we started the economy. Now suppose at time 0, our central bank raises the interest rate to 3% for 2 years and then drops it back to 2%. And suppose first we are in the blue world, where at year 4 we expect that the inflation rate is 0. That's the long run steady state. In that case, well, nothing happens between year 4 and year 2, so we will still expect that the inflation rate is 2%. So we expect in 2 years the inflation rate is 0%, sorry. The interest rate is now higher, so inflation has to drop. So inflation will go down and will be negative at time 0. Okay? But suppose our 4-year expectation is a bit larger, and in these, at least in these graphs, quantitatively this is not much. This is like 5 basis points or so. Assume we expect 5 basis points inflation in 4 years. Well, then the graph looks like that. So inflation goes down now, but then it comes up, it overshoots the 0, and then it comes down again, so that it matches our expectation here. And now assume something more extreme, that the expectation here is even higher, and I've plotted that by just what is the graph that makes inflation not jump today. Well, then we get something like this. You raise the interest rate, inflation comes up now, and then it comes back down. Okay? So there's this problem in this model that this multiple equilibria gives you vastly different predictions for what happens to inflation for something as simple as raising the interest rate. And then what happens for the output gap too. So you may have one question, and that is, what about policy rules? So far I've just given you interest rate paths. And in fact, when I was in grad school, no one even told me anything about this. We just wrote down a Taylor rule from the start. We said we have to put this larger than 1, otherwise it doesn't work. And then we worked with this. Okay? So let's do that. Suppose we have a feedback rule. We have the interest rate is equal to some intercept that may be time varying plus phi times the inflation rate, where phi is a reaction coefficient that reacts to actual inflation that's observed. Let's plug that into our combined IS-Phillips equation. So this was the inflation term. Now we have, well, actually, we have I minus inflation. Okay, there is still this intercept here. Then there's minus inflation. That's phi times inflation. Inflation is this thing. And then there was an inflation term by itself. So that's why you get a phi minus 1, because you have I minus pi, right? And this comes from the pi, and this comes from, this comes from the I, and this comes from the pi. So you get phi minus 1 here. And then you see one thing. So first of all, what's the solution structure of this equation? If you just ask mathematically how many solutions are there, there's still going to be a continuum. It hasn't changed. The fact that I've plugged something in here hasn't changed anything. But what has changed is the sign of this coefficient in front of this one. Okay? So if phi is smaller than 1, what I've implicitly assumed, I've done phi equal to 0 so far, this coefficient is going to be, let me see that, have I done this right? I think this minus is wrong, no? I think, yeah, I think it should be the opposite, right? Because you have that if phi is equal to 0, it should, let's just check it here. Yes, I did a sign error, so this should be a plus. Okay, so if phi is equal to 0, there's a negative feedback. If utilization is higher today, it's going to go down in the future. So everything is going to converge nicely in the future. That means no matter what I think today, in the long run, we always will have a bounded path. And all these equilibria in the long run will be very close together. So small changes in expectations in the future will move me to another of these equilibrium paths. If phi is larger than 1, we get a vastly different picture, because then we have a positive feedback. So remember, this is a plus. Okay? We have a positive feedback. If U is higher, growth rate of utilization goes higher. So if it's if I'm on an unbounded path and I raise, or if I'm on a path, yeah, or if I'm on an unbounded path and I raise initial U, then I'm also on an unbounded path. Okay? And you can show all but one of these paths is going to converge either to plus infinity or to 0. Okay? Because I haven't taken log, so it's 0. And just one path is going to be bounded. And that one path will have no other equilibrium paths nearby, because they all diverge away from it. And therefore, that's this concept of local uniqueness, that you have an equilibrium path that if you change expectations in the future a little, then actually you are not on a different equilibrium path. And that's usually what the New Keynesian literature uses as its solution concept for uniqueness. So this is not going to be globally unique, but it's locally unique. And then there are all types of fixes to make it globally unique, because they all diverge. So let's somehow rule out all these diverging paths, and then this is the only one that's left. Okay? So our Taylor rule can solve the multiplicity problem and can give us a unique equilibrium. Okay? Now, one immediate question: do Taylor rules, in a sense, refine the set of all equilibria? Are there some equilibria? Before I told you, give me an interest rate path, then there's a continuum of equilibria. Are all of these equilibria that can be selected by some Taylor rule, or are some equilibria not selectable by Taylor rules? And the answer is the former. So all equilibria can be selected by some Taylor rule. So suppose this is the interest rate path that generates some equilibrium inflation. So there is a continuum of these paths, but let's pick one. And then let's just write a Taylor rule around it. So let's just take a phi larger than 1, and let's make the intercept in a way that the reaction coefficient cancels with the intercept. This is still an equilibrium. I haven't changed anything, right? And now we have a reaction to it. So now we have made it at least locally unique. So that shows you any equilibrium for fixed interest rate path can also be supported by a suitable Taylor rule if you adjust the intercept accordingly. So can be selected by a Taylor rule is not an equilibrium selection criterion that actually refines the set of equilibria. Of course, can be selected by a very specific Taylor rule is. But if you just say the class of all equilibria that can be selected by a Taylor rule is the same as the class of all equilibria that you get if you think about a fixed interest rate path. Okay, here's a small summary about what we learned from this little model. Inflation is guided by a purely forward-looking equation, by this combined Fisher-IS equation that doesn't have a terminal condition that's determined by the model. And then monetary policy is basically about managing expectations in that equation to implement a desired outcome. And there are two logical dimensions to that. One is you want to anchor at some future date the inflation expectation, and you can do that by a Taylor rule. You don't even need to follow it today. You only need to follow it at some point in the future. So you want to anchor expectations to select an equilibrium. That's equilibrium selection in a sense. That's one aspect of expectations management. And the other one is if you've anchored something at time t, but you want to implement some outcome at time 0, you need to convince markets that your interest rate path between 0 and t is going to be a certain way so that you get the desired time 0 outcome. So these are these two dimensions of expectations management. And in principle, if you manage to do that, and in this model Taylor rules work for that purpose, then you can then interest rate policy is also going to have the conventional effect. So if you raise the interest rate, it will lower inflation and it will reduce economic activity. That's what I just told you. If you've anchored the expectation, you get these conventional effects. Now something about optimal monetary policy. We know from the standard literature, the interest rate policy can implement a first best in this environment. How do you do that? You set the interest rate that on the equilibrium path is equal to the natural rate, the real rate in the real model, okay, or in the flexible price model. And you use equilibrium selection to make sure that's the one that's picked. Because if I just do this path, I still have a continuum of equilibria. So I want to use equilibrium selection to make sure I pick the zero inflation equilibrium. If I do that, I get R is equal to R star. There should be a T. Inflation is 0. Output is on target, sometimes called divine coincidence. Okay, this is the standard textbook New Keynesian model, basically. And the main thing about monetary policy is you want to manage expectations, you want to select the right equilibrium, plus you have to move the nominal interest rate to make the Fisher equation consistent with zero inflation. Questions so far? Okay, let's do something else. Let's add government debt, and let's look at a different view of the world. It's not vastly different, but it's a bit different. Yes?
Sorry, just a question regarding what you said before about choosing a phi that will give me a particular interest rate path.
Yes.
And that's, so if I have phi greater than 1, it is still true that the neo-Fisherian effects go away, right?
Well, and yes and no. So the question is, mostly what people often do is they write a shock here, and then they ask, how does inflation react to that shock? But sometimes the normal interest rate goes in the opposite direction of the shock. So that's a bit of the trouble here. So you can still select equilibria because it's the same set of